It's a warm welcome to everyone joining us today. My name is Eamon Cunningham, and I am the president of the RIMS Australasia chapter. I acknowledge the traditional custodians of the various lands on which we work today and the Aboriginal and Torres Strait Islander people participating in this session. I pay my respects to elders past, present, and emerging. Now to some housekeeping for today's session. All cameras and microphones are currently turned off, and please ensure that they stay off to avoid disruption at this stage. We will be using a Q&A function that's at the bottom of your screen to ask questions. Please type your question, but also feel free to vote up any other attendee question that you would like to see answered. You can also use the chat function should you wish to connect with another attendee. Please note that this session will be recorded and distributed, so be conscious of this when asking questions. So everyone logging into this session today would no doubt have a story to tell about their interactions with the insurance marketplace in recent times. It seems that the reversal of what was a long-standing soft market has been given added impetus by a number of factors, including a once-in-a-lifetime pandemic. Historically, one of the important aspects of any interaction with the markets has been the creation and nurturing of long-term insurance carrier relationships. Are they still relevant and fit for purpose today? Joining me today to share his thoughts on all of this is David Bidmead. David is President Global Clients at Marsh and is based in New York. He is a proven leader and visionary change agent whose record of accomplishments includes 4 years as Pacific Region Head and CEO of Australia, 2 years as US West Loan Leader, and 3 years as CEO of Marsh's US operations. In his most recent role, David guides the Marsh's multinational client service practice. David joined Marsh in 1995 and now enjoys more than 37 years of experience in the risk and insurance industry. And besides the above-mentioned senior leadership positions, he's been involved with alternative risk financing, captive management, financial and professional risks, and importantly, complex claim advocacy. He is an active supporter of Marsh's global diversity and inclusion strategy and is also a member of the Marsh and McLennan Global Senior Leadership Council. David, a warm welcome to you and thank you so much for joining us this afternoon, but not from New York, but rather from Melbourne.
Thanks, Eamon. It's really good to be here.
David, everyone on this call probably has a reason why the market turned in recent years. And as we all know, this market direction continued with such force in 2020. However, I'd like to get your perspective on this, and in particular, why is it that the reaction from carriers seems to be so strong that corporate managers feel, as a minimum, they have been shortchanged in some instances, but in other cases, simply abandoned by carriers with whom they have invested so much time in cultivating relationships?
Well, thanks for the question, Eamon, and again, thanks for the opportunity to have this conversation, which I think is just so important. This question that you've just posed, for me, is the foundational issue. And the way I think about it is maybe in two parts. The first is, what does the data tell us? What is the data that's informing some of the positions that are being adopted by insurers in the market? And then what are the other influences that have kind of got them to their current stances, and how are those two things impacting the feelings of some of the clients that companies like Marsh represent? So let's deal with the first issue. As you know, Marsh produces on a quarterly basis what we call the Global Market Index. And that tracks quarterly movements in rate across the major insurance regions, major markets, by class of insurance, and then on a cumulative basis. So during the last 4 quarters, the Pacific region has evidenced amongst the most significant year-over-year rate increases, with the third quarter of 2020 producing a cumulative rate movement of plus 33%. That was second only to the London market, which was a point higher. So the reality of the market conditions that you describe, are clear and present. So there's no doubt we're in a very difficult market, particularly in this part of the world. If you talk to equity analysts and some of the people that occupy senior executive positions at some of the world's largest insurance companies, what they're going to say is, well, yeah, that's true, we're after rate, but you've got to understand that we've had decades of low investment returns, we've had inverted yield curves, we've had only 3 of the last 20 years where the operating margin for the industry as a whole has been in excess of 10%. We've had 5 out of the top 10 most costly, catastrophic years in the last decade. And then the final clincher is if COVID actually plays out in the range that it's currently in, the pandemic could cost the insurance industry globally somewhere between 40 and 80 billion US dollars, which would make it the most expensive cat loss on record. So that's all the data. And that sounds super apologetic for the insurance industry, and it's not meant to. But that's the basis upon which many of the insurers are basing their positions. The other influence, which I think is particularly relevant and one that we need to spend a fair bit of time thinking about, is that we've seen a generational change at the C-suite of many of the major insurers in the last few years. And that change has brought with it, I think, a steely determination to restore profitability, to restore technical underwriting, to centralize decision-making, and in some cases dilute the value of long-term relationships that people on this call have spent a lot of time and money developing. The disconnect, that sense of abandonment that you talk about, is sometimes an inability of the insurers to demonstrate genuine empathy and understanding about the trading conditions that the client companies find themselves in because of the pandemic. So if you think about your corporate experience, you either see the pandemic as a balance sheet event, an earnings event, or both. Let's assume that you see it as an earnings event. Your focus is on reducing your operating expenses. So at a time where you've got less money and there's a laser focus on reducing operating expenses, your insurance representative or your insurance company will both walk through the door and say, not only is that line item going to increase, it's going to increase not with a 1 or a 2 in front of it, but with a 3 in front of it. And that, in my opinion, are the major contributors to the sense of abandonment.
Okay, David, thanks for that background. So given all of that, is there value in continuing to nurture these relationships? How do you do so, assuming that we should do so, given all that's gone on?
So some people on this call might be irritated by what they perceive to be a mealy-mouthed response, and the response is yes, but. I think it's complicated, and I think it depends. Let me try and explain. So in my humble opinion, any relationship, whether it's personal or professional, needs to have a couple of attributes. It needs to be authentic. It needs to be tangible. In other words, you need to be able to hold it in your hand. It needs to be mutual, and it needs to be sustainable. So if you think about, from a business perspective, value, at least for me, is defined by professionalism, how you show up, responsiveness, and a genuine willingness to see the world through the eyes of the other person. The current market is really challenging this stuff. So when I'm negotiating at my client side, my primary role, as I see it, is to have some insurance representatives stop talking and start listening, and really demonstrate a real preparedness to be empathetic and understanding. I see a growing number of instances where there is a distinct lack of preparedness to do that, either because the numbers just don't stack up, or the person on the other side of the table is under very specific instructions to drive a particular agenda. And candidly, Eamon, in those situations, despite all very best efforts on behalf of Marsh and our clients, sometimes you need to recognize that you need to pivot and do something else. That sounds more dramatic than I want it to. We have preserved the integrity of long-standing relationships more than we've seen them be set aside. But we have encountered situations where long-standing relationships, which were candidly friendships, have been ended because we just can't find a way to agree at anything that is bordering on being reasonable.
Wow. Like you mentioned in your response, David, the concept of driving an agenda. My old boss used to say to me, Eamon, if you need to get something from another organization, go and talk to God there. Given the posture of the markets today, to what extent is this piece of advice still valid? How do you determine who is the right person, and how do you then achieve access to them today?
Well, I knew your old boss, and I knew well the importance that he placed on having the CEOs of certain insurance companies and certain insurance brokers on speed dial. So I get that. Look, I think that knowing who the principal decision makers are on any particular issue, whether it's coverage related or claims, is arguably the most important influence on both the most effective communication path and also you getting to the right outcome. Throughout my career, I've always placed significant value on knowing who both is responsible for the decision, but also who owns it. I think you can waste a lot of time and spin a lot of wheels in this market talking to the wrong people. And as I mentioned before, the last 12 to 24 months, we've seen a lot of changes in the industry, not only at a C-suite level, but at a line underwriter level. And I think it's very, very necessary to ensure that you have clarity, both as a company and your representatives do, about who the principal decision makers are. Why is that important? Is because sometimes the ultimate decision maker doesn't exist in your pond. They live in another part of the world, in a different time zone, with a different culture, and sometimes a different language. And how you're going to think about that petition and that pitch is sometimes influenced by how that person's put together and where they are. So for me, it's a really critical issue.
So clearly, despite all that's going on, we still need to talk. How do you start preparing for this discussion? What do you need to do to be as impactful in a positive way, naturally, as is possible in the circumstances?
So I'd like to sugarcoat this answer, Eamon, if I could, but I can't. So I'll just call it the way I see it. There's actually no way to avoid doing your homework. I'm not sure that everybody does their homework the way that perhaps I do. And maybe it's an insight into my rather OCD personality, but if I'm accountable for doing a really important meeting, which is really a negotiation, whether it's over a placement issue or a claims issue, I try and profile the person or the people that I'm meeting. I do the research on what's available online. I read what they've written. I watch their videos. I try and kind of understand how they put together what's important to them at the moment, and why are they sort of driving a particular agenda. At the end of the day, I think it's about genuine empathy and understanding. It's trying to generate a connection with them so that when I approach them and when I do that at my client's side, we are trying to demonstrate decency and respect. And I think that preparation is a really tangible evidence of doing that.
Great. Like obviously, and you mentioned the very important aspect of the macro level relationship stuff, but once you've covered that macro level relationship stuff, what are, say, the top 3 things at a more day-to-day transactional level that you need to focus on in setting up this discussion?
It's it's funny that you mentioned the top 3 things. A guy that I used to negotiate against, who was the CEO of an insurance company, only lived by the rule of 3. And he said, if you're going to talk to me about any issue, if you mention any more than 3 issues, I can't remember what the 4th one is. And it was good guidance. So I think about the top 3 things. So let's assume it's a placement issue. As I work around the world with various placement teams, I ask them to help me to understand what are the top 3 influences that impact things like attachment point, line size, scope of cover, limit, premium. And out of those things, what are the top 3 issues that are impacting the negotiating position of the insurer overall? So you might have a dozen issues, but not all of those issues are equal. And my sense is, unless you know what those foundational things are that are driving an entrenched negotiating position, you really can't do the work. And the work means, okay, now I understand that these are the top 3 things that are influencing their position. What are the things that I can do to create a different point of view, if I can? And what is the work that I've got to do? What is the data that I've got to gather? What are the insights that I've got to provide that may not be immediately apparent to the insurer or their representatives? And look, I've learned, particularly over the last decade, insurance companies can write a client's business for 20 years, and they can really believe that they understand at a very granular level the client's risk profile. And I've been reminded again and again and again that business moves so quickly these days, and risk profiles change and evolve. And if we're only meeting these guys once a year, lots happen. So I think that there is this real necessity to understand on a regular basis what are the top 3 issues that are driving their perception of the risk. And sometimes they'll be surprising to you.
I'm glad, David, that you mentioned the concept of risk profile, because clearly there's a lot of change going on right now at all levels of business, some of which is fundamental, all of which impacts everyone's risk profile. What do you say to risk managers about what she or he should be doing today to present themselves and their company, their organization, in the best possible light?
So I believe it's a continuation of a story. And particularly if you've enjoyed a relationship with an insurance company for a long time, I'm encouraging our clients to never really enter those annual renewal negotiations with an assumption that they know or they should know everything about your risk. despite the fact that you might have provided them with all the relevant risk profiling data. I think that as your business changes and evolves, as you develop new chief executives and roll out new strategies, you pursue new areas of growth, new products, new approaches to technology, it's super important to continually remind your insurers, the providers of risk capital, what you think it means for your risk profile. So maybe two examples, Eamon, if I can. The first is, digital. So there's plenty of chat at the moment around the world about how companies are approaching a new digital strategy. And insurance companies are wondering, so what does this mean for their risk profile? Got to do the work. You've got to consider the likely impact on your risk profile as you roll out your digital strategy, on your assets, your income, your liability, and your people exposures. You've got to engage specialists to help you define severity and probability, perhaps people that you've never engaged before. You've got to bring in new experts within your own organization who can speak with more clarity and granularity about these things than perhaps risk managers can. I think one of the most telling examples that I can recall recently is in the life sciences industry, where major pharmaceutical companies are developing some pretty funky new molecules to attack medical conditions. Now, major insurance groups that are focused on life sciences don't just have line underwriters. They've got people that are pharmacologists. Those pharmacologists inform underwriting decisions, and they want to talk to people within the life sciences companies who understand how the molecule is developed, its active constituents, the outcomes of clinical trials. They want to be able to get involved in a Q&A, which supports a recommendation to deploy meaningful risk capital. It's only meant as an example, but that's an area of business where their growth in terms of product deployment has never stood still. And yet we've been able to, as an industry, provide credible and sustainable solutions in that area. I think there's some lessons to be learnt from that. Certainly ones that I've learned, particularly over the last decade.
And it's interesting that you mentioned lessons to be learned, because clearly corporate risk managers recognize that all of their peers are always out there pitching to the markets. Can you share with us what we should be doing to profoundly differentiate our own risk profile?
Well, perhaps the answer might be back to some of the comments that I made about understanding what the top three issues are. I think that's a start. Asking yourself, does the information that you have at your disposal that's related to your risk profile on those three issues in particular, does that help your position or does it hurt it? So maybe another story, Eamon, if I can, to bring this to life. I was traveling with a client in London last year, and we were attempting to take a certain aspect of their risk profile out of the global program and create a new program to deal with what was a pretty scary aspect that was negatively impacting the preparedness of the global panel to deploy capacity to finish off the program overall. So we needed to be really focused on how do we present that in a way that's not going to freak the market out, that's going to produce an outcome which is in line with our target terms and would optimize the client's economic cost of risk. Our London placement team advised us that a very similar organisation had walked through the market about 3 months before and encountered a lot of difficulty with data quality. And the reaction from the market was, oh, your client looks exactly like that client, right? They're in the same industry, they get the same kind of risk. Therefore, you guys must be as bad as those other people because you look the same. In fact, you do the same thing. Now, our London team were great. They tipped us well in advance that this was an issue. And what do you think our number one focus was? Data quality. We actually began the presentation acknowledging that data quality was the number one issue for this industry. And we rolled out all the things that we'd done in the intervening period to do the very best job we could, presenting a clear, unambiguous, data-driven risk profile that allowed them to make informed decisions. It shocked them. It shocked them that we knew. It shocked them that we'd done the work. And when we presented the story, they had no real choice other than to say, wow, this is really different to the other guys. And you know what? We're excited about the possibility of participating. So simply put, know the issues, do the work, gather the data, triple check it before you present it to make sure you're focused on the right things, and make sure you've got online real-time intel about the position of the people on the other side of the table.
Sounds like it is very much a case of really do the homework, and as you indicated by your story, that sometimes the point of difference may well be what is perceived to be the weakness in other, say, sectors of the same market that you're involved with, and to show how you don't succumb to that weakness, and that becomes your point of difference.
That's exactly what we did. In the strategy meeting, the sense was this can actually be the most potent differentiator because we have done the work. We do understand the data. We are materially different. We can either get emotive about it or we can just clinically dissect the issue and present it in a very objective way. And look, our client was superb. They invested a huge amount of time and money in getting into this issue, doing things that candidly they'd never done before to present the risk in a particular way. But the results were really, really good and within our target range. So we were happy.
Well done to you. David, all carriers and some corporate buyers keep what we call trading ledgers to illustrate long-term profitability. Can you comment on the value of maintaining them when it seems that carriers right now are only focusing on one thing, the upcoming renewal period itself?
So Eamon, I used the phrase, it depends before. Trading ledgers, it depends. We have some clients who have presented very profitable relationships to their insurers over many years. And we proudly dust off that trading ledger. We update it, we put it in neon lights, and we flash it up in the presentation as frequently as we can. In other instances, not so much. I think the most important thing is you've got to pick your mark. And you've got to be mindful of the global trading ledger, not just the regional one. And you've got to look at it holistically because it can make a difference. I'd also recommend that you use the same data as the insurers. And if their data is wrong, tell them that it's wrong before the meeting. I can tell you that one of the most irritating aspects for me is when I walk into a meeting and our placement team and our client has focused on a particular storyboard using a particular trading outcome. And we begin to talk about it and the insurers might say, well, they're not the same figures that we use. So again, OCD tendency, I kind of share my trading ledger with the other side before the meeting to give them the first right of refusal to say, that's not really in line with our stuff.
So essentially one less point of difference to argue over during valuable meeting time.
Well, once you get through where you're going to do the meeting and which technology platform you're going to use, probably the next thing you should agree on is what's the data pack that's going to support the meeting.
Sure. Before I move on to the last few questions that I have for David during this phase of our chat, again, can I just remind everyone to feel free to use the Q&A button at the bottom of your screen to type in a question. I see we have one already, which I'll come to very shortly, but please avail of that opportunity. It's your meeting. David is just simply kindly providing responses, but we'd love to hear from you. David, we're all human and no one likes delivering bad news. So what's the best approach when you have to have discussions on topics like poor loss history with carriers?
Well, I'm happy to be corrected on this call, but I think very few people relish the prospect of a difficult conversation. So whether it's with the people that you love, the people that you work with, report to, represent, or negotiate against, difficult conversations are things that people really don't like. So you get a choice. You can either come to those forums with authenticity and a preparedness to establish what I define to be an equitable communication platform, and you do it early, or you don't. So again, another example, Eamon, if I can, just to sort of prove the point, because people's minds are saying, yeah, I do that all the time, and it didn't work out for me, so I don't do it anymore. You know, I dig a ditch at 40 paces and I appoint an attorney and, you know, we're just going to litigate. You can do that. And sometimes we do, right? But one example that really lives now in my memory, and I bring this one out when people ask me about the value of doing difficult conversations, is this one. I mean, as you know, and some people on this call know, we have the privilege of representing a large percentage of the Fortune 50 companies. And by happenstance, luck, by the grace of God, I'm the senior relationship officer on a number of those. And we were preparing for a big renewal. And this client suffered a claim, which was larger than $500 million. And it was complex. Now, it was about this time a couple of years ago, and this client has a big renewal at the end of the first quarter. And let's just say that the claim, its value and its circumstances got the attention of everybody in the market. Everybody. So my learned client said, so what do you reckon we should do about that? And I said, I think we should invite them to come to New York, your lead insurer, just your lead insurer, and we should chat. We should chat about the claim. We should chat about the impact on their renewal position. We should chat. And this is in December. And he said, do you think they'll come? I said, yeah, I think they'll come. Who should we invite? He said. I said, well, you should invite your line underwriter, his boss, his boss's boss, the chief claims officer, and the case file manager. Why would we need to invite all those people? Well, because what I'd like is I'd like them all to hear the same story at the same time, in the same room, in the same language. I'd also like to hear them hear each other say things, make commitments. Okay, so predictably, we orchestrated that meeting pretty good, not only from the client side, but also from the carrier side. And I mean, I've got to tell you, I was surprised that the meeting was difficult and it was a little tense because of the value of this claim, but you know, it went really well. And we not only talked about a lot of difficult issues, we resolved how the claim was going to be managed going forward. We talked about communication, we talked about data sharing, but you know, we also talked about their position on the renewal 3 months out. Now, we didn't ask them exactly what their line was going to be, and we didn't exactly ask them about what their premium was going to be to the dollar. But what they did say was enough for us to know with confidence, because there was no one else in the decision-making tree, apart from their CEO, that we were going to get surprised 2 weeks before renewal, right? And that wasn't the only meeting we had in those next 3 months. We had a number of them. The long and short of it was we renewed that program with that carrier as the lead. They maintained their line to about 90% of pre-loss level. And they offered what in the final analysis were acceptable terms to my client. Yes, they did pay more money. And yes, we expected that to happen. But we found a way forward, and we did it in what was, for me, one of the most challenging circumstances that I'd encountered. Let's say our placement teams around the world had some pretty faint-hearted moments prior to that meeting, and we invited some of them to participate simply so they could see the opera play out. But it was a learning, not only for me, but for them. So I'm a bit of a convert in those kind of forums.
I think what I'm picking up from you, David, is again, do the homework, analyze the issue, perhaps potential opportunity, and execute. Yeah. David, at the end of the day, any discussion is not just totally about numbers, about the numbers. Personal attributes always come into play. Have you any guidance for us in this area?
Well, I'm revealing a lot about my personality. You know that because you and I have known each other for a long time, but some people on this call may not know. I think it's a reflection of how we all move through the world. And you get a choice, right? You either treat people with decency and respect as you find them until they prove you wrong, or you don't. And I think it's important as we try and manage what are increasingly complex and difficult issues in the insurance industry that we leave our ego at the door and we try and separate what is in some ways a very clinical reality about a placement or a claim from some of the more emotive issues that are associated with failure. So some of us all sort of cascade to the failure point before we start, and we get so wound up in the negotiation. It's like a match lighting a fuse, and we hear the wrong phrase or the wrong words and we just go off. You mentioned attitudes and actions, character traits. For me, I think professionalism is about attitudes and actions. They're conscious choices, and you develop that behavior over time, and it impacts your brand. You're either known as someone who's professional or you're not. Patience and persistence, though, they're character traits. You're either patient or persistent, you're doggedly determined, again, or you're not. And I think the current market conditions, Eamon, have brought out the very best and very worst in some of us. And I think patience and persistence is really at the top of that. I worry sometimes that some of our young professionals in the industry, people that are perhaps got more hair or a different color to me, I worry that at the moment they don't have the necessary patience and persistence that it's going to take to get to maybe, not yes. I've learnt to be patient over a time, and I've learnt that certain successful negotiations are non-linear. And sometimes you've got to ask the same question in 12 different ways before you get to maybe. And I don't mean to be paternal, but I have seen instances of where some of our young professionals will say, well, they've said no, so I guess it's no. Perhaps, but you need to go and ask them again. And I was involved in a renewal in June of this year for a really large company that we represent in the United States. And I reckon I asked the same question 16 different ways over a 2-month period before we got to yes. Now, the client that I was representing was a little tired of my persistence and said, we just need to do something else. But we got there. At the end of the day, we got there. And the conversation that I had with the carrier after the event was, we got to yes, and that was good, but you lost a lot of credibility with the client because your opening negotiating position and where we ended up was so different. I'm not sure that they have the same affection for you as what they had before.
Yeah, got it. David, my final question to you before I open it up to the floor for questions, and please just a reminder to type your questions into the Q&A button at the bottom of your screen. But David, do you have any parting word for us, particularly about what and how you frame your questions to the carrier so they understand exactly where you're coming from?
So I guess what we're talking about there, Eamon, is the ask, right?
Correct.
So you and others on this call who know me know that I'm really a frustrated psychologist. I'm fascinated by why we do what we do, and I'm kind of always looking for the trigger points in there. And I think to frame your ask, you've got to begin with empathy and understanding. You've really got to try and anticipate how challenging your request might be for the recipient on the other side. I'm a big believer in simplification. So I try and simplify the ask. I also clarify what it would mean for my client and I if we got to yes. I also try and be very clear about what we're prepared to give in return in terms of reciprocity. And then finally, again, because I'm a little OCD, I want to understand, so who's doing what next and when is that going to happen? Because sometimes, you can have a pretty good meeting and you might surprise each other with the ask and the response to the ask. And because we're all busy, we can sometimes hide in the virtual environment, and that sense of optimism tends to get eroded over time. And then you have the next conversation. It's almost like that last one sort of didn't happen. The final insight is I don't think the ask is supported in any meaningful way by shouting and screaming and table banging and threats of reciprocity in a negative sense. I know that is not a sentiment that's shared by everybody, but maybe it's a personal thing. I've never seen any sustainable arrangements, deals, agreements made at the wrong end of a loaded weapon. And it's just not something that I'm keen to do. I think that an agreement coming out of a difficult situation is the product of both sides being heard, understood, and genuinely cared for.
Well, wow. David, thank you for that. What I might do at this stage is open it up for questions. So the first question comes from Brian Rowlett. It's as follows. In most consumer markets, suppliers adopt strategies to weather a period of crisis and preserve their bonds with customers. They do this by humanizing relationships, educate customers about change, assure stability, and modify their offering with a view to the future. Why is it that insurance carriers do just the opposite when facing crisis of profitability and the need to balance price increases with longer-term customer relationships?
I think it's a great question. And, I think it speaks to one of the points that we made before, and that is providing the wrong evidence of genuine empathy and understanding. The reality is, during the pandemic, we've seen some of the world's biggest corporations see their revenue lines go off a cliff. And at the same time, we've seen the insurance industry continue to demand rate, and in this part of the world in particular, material and massive rate increases. There's a disconnect. And people are missing each other in terms of the genuine empathy, understanding, and the impact. I think the other thing is that insurance companies, and I'm generalizing, but some insurance companies believe that the majority of their clients will accept the need for them to restore profitability. And none of us on this call, I think, would ever begrudge the insurance industry for being profitable, solid, stable over time. The disconnect is, when is that going to happen? How is that going to happen? And how long do you need for it to occur so that the people that are actually paying the premiums have a breath to pay them? And we've found situations where long-standing relationships are ended because there's not a disconnect about the need for rate. There's a disconnect about how much is reasonable in the circumstances.
Got it. David, the next question comes from my board colleague, Kevin Bates, and it's both a comment and indeed a question. And he says, David, firstly, thank you. As always, the clarity of your delivery is matched only by the content you deliver. Indeed, praise indeed, sir. Thoroughly enjoyed this session. But he says he does have a question or an observation. He says, I agree that relationships are critical to how those play out and how those play out over time changes. That said, would you agree that there is a decrease in the ability of the underwriter or regional CEO to call let's say an issue based upon the relationship for fear of straying too far from technical pricing based on obviously orders from headquarters? In other words, will headquarters always triumph over regional views on relationships? Kevin asked for your thoughts on this.
Well, Kev, thanks for the positive feedback, much appreciated, and thanks for arguably the most difficult question of the afternoon. I made the point before that as a product of that generational C-suite change that we've seen through some insurance companies, I think CEOs and chief underwriting officers are bringing a lot of decision-making back into the center. And we, collectively, clients and their intermediaries, have used the historical fragmented nature of decision-making in a very effective way. I think the opportunities to do that are diminishing quickly. And I think the ability to tap a rogue underwriter to do something that's not consistent with boilerplate underwriting authority, consistent portfolio rebalance direction, I think is diminishing. That really, in my mind, underpins the importance of having a multi-tiered relationship network. So it's not because you want the ability to go around or above your regional CEO, but it speaks to the point that I made before. And again, it's just one man's opinion. You need to know with clarity who owns the decision. And if it's not the regional CEO, if it's the chief underwriting officer who exists in another country, that's the person who you've got to petition to. You can be the best of friends with the regional CEO, and that person can be a really important cog in the local wheel. But if he doesn't have the ability to increase the line size or vary the attachment point or reduce the requested premium rate, he's still a good person and he's still a great friend, but he's not as valuable to you in a business sense as perhaps he once was. That sounds super harsh, but it speaks to that necessity to be clinically detached from the emotional issues of getting to success.
I get it. In this brutal world of ours, it's all about delivery.
It's all about who can agree.
Yeah, I agree. David, the next question is from a person that you and I know very well, the one and only Scott Ritto. Scott, welcome from LA, where he's obviously joining us. And Scott says, greetings from the US. And Scott, in addition to his daytime job, is heavily involved with the RIMS LA chapter. So he says, it's nice to see you both and thanks for the session. Great insights. It appears that this market is straining relationships, even with long-standing carrier relationships. Even when you are delivering a loss ratio of well below 10% over several years. Do the insurers understand or care that they are putting many risk professionals in precarious situations with their senior leadership as we try to explain a market that does not always make sense?
So there's two parts to the question, and Scott, thank you. The first is, do they understand? Yeah, I think they do understand. The second part of the question, which is arguably more important, do they care? Once again, it depends. So I think it depends on company culture, individual character traits, scope of responsibility, and whether they're accountable for dealing with a portfolio that's underperforming, overperforming, or somewhere in between. I would say in situations where you have a very favorable loss ratio and you're not feeling like either you're positively differentiated from relevant peers, or there is any hope of your message getting through at a level where you can impact the decision, you need to identify credible alternatives. And if you've got a loss ratio of less than 10%, even in the current market, there's plenty of insurance companies that are chasing less than 10% combined, right? So I think that's where the broker needs to step up, to present real-time intel about who's hot and who's not, and to say, if your current market is not prepared to do this, here are the top three, using the rule of three again. These are the top three carriers who we think have credible alternatives, and here's why. You need adequate time to pursue those options, clearly, and you need to do more than one meeting to actually get the sense that they're a credible alternative to your current player.
Got it. Thanks, David. I've got an interesting question from an anonymous attendee who states, thanks, David, for the presentation. It sounds like you are saying that whilst relationships are important, the real value for a renewal is in the provision of accurate and on-point information. If you did the latter with no relationship, would you have the same renewal result?
I think it depends on the company. And I think it depends on the ultimate decision maker and whether they're clinical or not. I mean, I've done meetings in the last few months where we have had relationships that go back 20 years. And we have a portfolio trading balance with a particular company, which is pretty dismal. But we've set that aside and we've focused on data quality and the evolution of the company and what's coming up. And you can sense that the investment that we've all made in those relationships counts. In a recent meeting involving a April 1 renewal, we got confirmation from the insurer in November that they would maintain a massive current line, and they gave us an indicative premium range for their participation. Now, that was in November for an April 1 renewal in a scary industry sector that's hugely volatile, where, let's say, the trading balance has been challenging.
Right.
In the absence of that relationship, if we were just presenting the ledger and we were asking them with zero relationship, so what's your intention regarding your current participation, and can you give us a sense for what your negotiating range is on the premium? I think we can all predict what that outcome is likely to be. I mean, one final part to that answer, and it's a claims-related example, not a placement one. Marsh has a very large client in the United States who have had, it's not a large claim, but it's big enough, declined by one of our biggest trading partners. And the case file got to my desk and I took a look at it. And I phoned the general counsel of the client and I said, how do you think we have collectively managed this case file? And he said, it's awful. That's why we fired the risk manager. And we inherited responsibility for this. And I said, so I just want you and I to be on the same page. We can't sugarcoat the fact that we're in a good place here, right? And the reason that the insurer declined the claim is because in their mind, we failed to cooperate. So the only way we can get this case reopened is by personal petition to their chief claims officer. So I'm going to phone him and I'm going to tell him that we didn't do well, and I'd like him to consider this to be a personal favor and consider, not do, consider reopening the file. Now that one's still pending,
right,
but it's an example of you can't create a silk purse out of a sow's ear, right? And in a situation which looks bad and smells bad and probably is bad, to insult someone's intelligence by trying to present something that it's not, will just get another negative reaction.
Great. Well, we just have one final question, and it's coming from a carrier. So it's a question from John French. Good afternoon, John.
Hey, John.
And John's question is as follows. David, fully support your views regarding the real need for a deeper understanding of risk profiles. But how do we, as an industry, convince our traders, negotiators, to reward clients that we have a proactive attitude towards data provision, risk improvement / mitigation, and not simply base terms and conditions and service on the risk itself? P.S. And John says, and it's a lovely segue into our next section, it's been too long between drinks.
I agree. Thanks for the question. You know, John, at the risk of stating the obvious, and I apologize in advance for putting you on the spot, lead by example. You have a position, wow, that was pretty cool. Hey, you have a position in the insurance industry which allows you to lead by example. And your company is of sufficient substance as a market leader to publicize the fact that you will reward clients who define their risk profile in a very granular way. You pick a couple of major industry segments that drive a disproportionate amount of your gross written premium, and you make it known that this is how you'll successfully differentiate, and this is what you want in return. The insurance broking industry would welcome that opportunity. It would stop us having to scratch our heads and go to our rule of three and sometimes make it up as we go if we don't get an accurate answer from your underwriters. But you know, we're going to keep pushing. And we've learned a lot of things, particularly over the last 12 months, about how to present evolving risk profiles in a virtual world. And I think that's the key. I mean, this pandemic is not going to change, certainly not globally, anytime soon. And this stuff, this forum, is going to be the way that we continue to do business. We can't sit across the table from each other. We can't look into each other's eyes in London or New York, at least not anytime soon. And for us to win the hearts and minds of principal decision makers, it's all about data quality and a granular understanding of a client's risk profile.
Great. Well, John, thank you for that question. And David, also your response. It's nice to, in your response, to effectively summarize what you've been saying to us during this session, which is all about doing your homework and be well prepared. Well, like from my point of view, that this session certainly speaks for itself. David, thank you for your time today and the effort you clearly put into this. Thank you, our audience, for being curious and interested enough to register and join us. I'd like to thank Marsh, one of our foundation sponsors, who has been with us from the very beginning, for their continuing support of the chapter. This being the last chapter event for the year, can I also thank all of our foundation sponsors for their continual involvement with us. Those sponsors besides Marsh being Allianz, AIG, Chubb, FM Global, IAG, Swiss Re Corporate Solutions, Willis Towers Watson, and Zurich. It just remains for me to thank Jess Abbey, who has worked tirelessly behind the scenes to bring all of this together, and to my board colleague, Kevin Bates, who is being involved in this as well. My board colleagues join me in wishing everyone a Merry Christmas, Happy Hanukkah, or a Happy Holidays, and importantly, a safer 2021. If you liked what you've experienced here today, just a reminder that you should consider joining the RIMS chapter if you're not already a member. Simply visit rims.org for further details. There will be a post-attendee survey. Please complete this. It'll be coming your way shortly, and let us know your thoughts. Before I close this, can I remind everyone that if you have the time and the inclination, please feel free to hang around to share a wine, a beer, or whatever with your industry colleagues over the airwaves. For those leaving us now, good afternoon.